Welcome, ladies and gentlemen, from me, Guy Monson, after a week off, to our regular 6-minute strategy summary. I'm going to concentrate this week on the impact of the second spike that we're beginning to see in European infections and what this means for financial markets. You can see the numbers quite clearly on slide 2 in the number of days since 200 new cases reported in 1 week. That yellow line, Spain rising sharply, France rising, and nascent rises in the UK and Germany. It's not been a universal phenomenon. The US numbers have been quite good, and in fact, global new cases did actually peak in the last 2 weeks. But this European spike is clear. It comes on the back, of course, of the Q2 GDP data which we saw, which really showed the full devastation wrought by the crisis. You can see on the left-hand side of chart 3, the Q2 data for the US down 9.5% quarter on quarter, the euro area 12.1%, and that horrific 20% fall in the UK. Now remember, the extent of the falls is partially how bad the economies are. Of course, it's the timing of the underlying lockdown, and Q2, particularly April and May, hit the UK very hard. On the right-hand side, just reported this morning, are the purchasing manager surveys for the last month in the UK and in Europe. And you can see, yes, a strong rebound, but interestingly, a faltering of those euro area numbers, while the UK numbers have continued to be quite robust, indeed quite substantially exceeded estimates. Now, this is just 1 month, but it's an interesting trend. In the US, where the lockdown has been eased a little faster, interestingly, some inflationary indicators are beginning to creep back into the underlying economy. That five-year forward expected rate, which we've monitored in all of these calls, climbing up down to 176, of course helped by a very weak dollar, the dollar at a 2-year low, allowing imported prices to push up a little bit on inflation levels. And that's lifted the yield on the UST bond, you can see on the right, from its ultra-low levels, not by much, but it's a slight reversal. Now, what do these divergent trends in Europe, the UK and the US mean for financial markets? On the left, the regular slide we look at across markets for a UK-based investor. Gold's still leading the run, but that fallback in the dollar has meant us come back in sterling terms. UK gilts easing off. Global equities now up 3% for the year. The UK market still hugely lagging. Really emphasises, by the way, the benefits of a global approach. On the right-hand side, you can see that very, very generous liquidity conditions continue to bear down on volatility, and that VIX index continuing to creep down, not yet at January-February levels, but a substantial reduction. Interestingly, a much faster decline than we saw in 2009-10, for example. That's useful to us because it allows us to reintroduce some of our portfolio insurance programs, which have been a characteristic of many of our balanced accounts. Drilling down a little bit closer to the markets themselves, look first at the S&P 500 on the left, an extraordinary rally of that blue line. The red line I've shown there is the S&P 500 equally weighted. That takes out the effect of the super caps, if you like. And you can see that that sharp spike we saw up in the early stage of the recovery, where the super caps lagged, has been reversed. And now both indices are moving in tandem. No surprise for guessing the culprits on the right, where I've shown the Fang Plus index. That's Facebook, Apple, Amazon, Netflix, Google, but also Alibaba, Baidu, Nvidia, Tesla, and Twitter. And you can see that extraordinary leadership pushed up again. Another interesting feature is you would have expected in this rally emerging markets to lag considerably. After all, they had less developed healthcare systems, huge pressure on their underlying economies, and of course social distancing was very difficult. But interestingly, the world markets and the emerging markets have rallied almost in tandem, helped I think by a weak dollar. Meanwhile on the right, commodity prices still robust, extraordinarily. Copper up 7%. You'd think in the deepest recession since World War II, that was hardly believable, and a slow move upwards in crude, but still a steady upward rally. So the risk for investors is clear. There's a second spike in Europe. Yes, there's a little bit more activity in the US, but this is pushing valuations and Fang stocks and their related members even higher. Why is this? Well, I think part of it is money is leaking into the markets from the huge money market assets that have been accumulated through the crisis. As people have spent less and saved more, they put it into money markets. And money market assets up almost $1 trillion since the beginning of the crisis. The second factor, of course, is that very, very low treasury bond yields on the right in red do encourage people to embrace risk and growth assets. And that's taken up the S&P 500 PE, here I've used the cyclically adjusted measure, up almost to the highs pre-crisis and not far from the highs seen in 2000. So how should investors react? Well, I wouldn't split the market so much by value and growth or by region Europe versus the US. You know, at Saracen, we look at the themes. And we're still very confident of our digitization theme, our automation theme, our aging theme, evolving consumption and climate. Allow those to operate and you'll get a spread. You'll get utilities, you'll get food stocks, you'll get pharmaceuticals. Yes, you'll still get some growth stocks. You'll get a broadly US-centric portfolio, but also Europe and Asia. Put that together and I think it's a good balance for a very uncertain economy as we look at the worries of a second spike. Thank you.